What are you trading away? Think about that for a second. Every single strategic decision you make fundamentally closes doors. Now, most people know this in the abstract, right? But what almost no one does is actually weigh the structural value of those closed doors before making the decision.
Welcome to this explainer on optionality. Now, we are not going to talk about optionality as some vague corporate buzzword or a generic safety net. We're going to look at it with serious intellectual rigor as a first-order strategic asset. It's an asset with real, quantifiable economic value that, frankly, most people just give away for free or trade away for far less than it's actually worth.
All right, Section 1, Redefining Strategic Optionality. To figure out how to price this asset, we first need to break down how most leaders fundamentally misunderstand it.
You see, the colloquial definition of optionality is usually just described as keeping your options open. And sure, that's accurate, but strategically, it's completely insufficient. It implies this passive state, like a residual afterthought. The strategic definition demands we treat it as an active capacity. It's a structural asset. And because so many players in the market view it passively, they fail to price it, which means ultimately they just give it away.
Section 2, How Optionality is Sold. Let's take a look at the exact mechanics of how smart, capable leaders unknowingly bleed this asset from their organizations.
So here are the 4 primary ways we drain optionality. When you take on leverage, you give it up. When you make a massive public commitment, you give it up. When you concentrate your exposure into a single bet, or when you just let operational complexity grow without a ceiling, you are giving up optionality. And I want to be very clear here. None of these moves are inherently wrong, but executing them without consciously pricing the trade-off, that is deeply destructive to your long-term strategy.
But what does that look like in practice? Let's anchor those abstract finance terms to concrete realities. Taking on leverage isn't just about debt. It's an operator building a massive fixed cost base optimized entirely for the current market regime. Concentration? That's a board letting a CEO hold every single key industry relationship in their own hands. And commitment is a founder locking a company into a rigid tech architecture way before finding product-market fit. Think of a company like Nokia stubbornly tethering themselves to the Symbian operating system while iOS and Android took over. When the regime shifted, they had already given away their structural capacity to pivot. The asset class differs in each scenario, but the mechanism of loss is identical.
Moving to Section 3, the value asymmetry. This brings us to the core thesis of mispricing, where the environment completely distorts our perception of value. Its value is lowest when things are going well and highest when things are going badly. Just pause and think about the gravity of that asymmetry for a second. The uncomfortable truth is that most people sell optionality at exactly the wrong time, simply because they evaluate it based on present comfort rather than future utility.
Just look at how our perception shifts based on the environment. In a bull market or a period of calm, optionality feels really expensive. Holding cash feels foolish. Leverage feels entirely rational. And concentration, well, that just looks like bold conviction. But then the regime shifts. The market turns. And those actors who maintain structural flexibility, who might have seemed conservative or under-allocated yesterday, suddenly have agency. They have buying power. They can redeploy capital to buy what others are forced to sell. The actors who optimize purely for the existing calm regime are locked in and forced to take losses, while those with optionality survive long enough to actually compound.
Section 4, The Skeptic's Pushback. Now, if we're being intellectually honest about trade-offs here, we have to look at the legitimate counterarguments to this framework. Because a sharp, pragmatic investor or a growth-oriented founder looking at this would rightfully ask, wait, doesn't concentration create an edge? If I never lock into a decision, if I always hedge my bets, isn't keeping options open just a fundamental lack of conviction? And honestly, that is a highly legitimate pushback. You cannot build a generational company or generate outsized returns without taking concentrated risks.
So, let's address that tension directly. Focused bets and irreversible commitments are absolutely valid strategic choices, provided these 3 specific conditions are met. First, the structural edge you possess is real and verifiable. Second, the current regime, the market environment, is deeply understood. And third, the magnitude of the bet is sized within survivability boundaries, meaning if you are wrong, you experience a drawdown, sure, but you don't face fatal ruin.
So the crucial structural point is this. The discipline is not in avoiding irreversibility. It is in never accepting it by accident. Intentionality is the entire game.
You can absolutely burn optionality to capture a massive opportunity, but you must do it with your eyes wide open.
Section 5. The Optionality Ledger. Let's transition to a practical solution and introduce the exact framework used to price these strategic choices before you make them.
The tool we use is called the Optionality Ledger. Step 1 is simple. Classify the magnitude of the commitment on a spectrum. Is the decision reversible, semi-reversible, or completely irreversible? You simply cannot price a decision until you honestly categorize how permanent it is.
Once classified, you run it through these 4 steps. 1. Liquidity impact. What does this cost in absolute flexibility? 2. Flexibility reduction. What specific strategic moves become harder or even impossible after making this commitment? 3. Dependency creation. What external assumptions must now remain true for this bet to work out? And 4. Strategic compensation. Why is the loss of all that optionality actually worth it? That 4th step, that's where true strategic discipline lives. If you cannot articulate the compensation, you shouldn't make the trade.
Section 6. Pricing your strategy. As we bring this explainer to a close, let's observe how the highest-level players in the market behave.
The most powerful strategic actors all share these structural habits. Think about sovereign wealth funds maintaining countercyclical rebalancing capacity, or elite long-term investors holding cash reserves through an extended bull market. They treat optionality as a first-order asset. They know exactly what they are trading away, they price it before they trade it, and they absolutely never give it away for free. Their capacity to act decisively during a crisis is born entirely from these habits.
I want to leave you with this single, lingering question. Are you being adequately compensated for the doors you are closing? The reality is, the question isn't whether to give up optionality. You have to make choices to grow. But under normal market conditions, with normal incentive pressures pushing you to act, if you haven't explicitly priced the trade, the answer is almost always no. Take the time to build your ledger, price your closed doors, and ensure every structural loss is an intentional, calculated win.